Today, I will be covering 5 driving factors of e-commerce business valuations and also looking at some deal examples from businesses that are actually listed for sale right now and discussing how these 5 factors may have impacted their valuation and what they're ultimately likely to sell for. So if you're interested in getting a better understanding of e-commerce business valuation overall, well, this is an excellent place to be. I'm going to be covering a lot here today. Now, to give us some context here, this is really applicable to physical product e-commerce businesses, not so much digital product e-commerce businesses, although there is some kind of carryover between the two of them. This is specifically for physical product e-commerce businesses with revenue of less than $10 million. And predominantly, I think we'll say skewing a little bit lower to say less than $7 or $5 million in revenue. As they get bigger on that scale and closer to the $10 million mark, things may kind of change around a little bit. And finally, we'll be talking in the context of multiples of monthly SDE or seller's discretionary earnings. Now, you might see these multiples annualized, right? So, for example, a 36x multiple on a monthly basis would be a 3x multiple on an annual basis. And the SDE is important to note. SDE is the common kind of baseline profitability metric for valuation in smaller businesses, whereas the businesses get larger. EBITDA, earnings before interest, taxes, depreciation, and amortization, will kind of become the more preeminent baseline for the valuation. Now, SDE, let's just kind of talk about the differences there between SDE and EBITDA for those of you guys out there that may not be familiar, because the terms are often used interchangeably or very interchangeably here. So you kind of have to have an idea of what you're speaking about. But ultimately, SDE is going to include all of the total compensation to an owner-operator. So in a smaller business, they're largely going to be owner-operated, particularly in the e-commerce businesses that fall in, let's say $5 million in revenue or less. So it's going to account for all of the compensation that the owner gets, whether that is, going to be their salary. And a lot of the smaller e-commerce businesses in the sub $10 million revenue range will not pay any owner operator salary, but the ones that do, they're going to add that back, right? So it's going to get added back and it's going to be included in the SDE, what the seller ultimately gets to themselves that they can discretionarily spend. Other things you might see in there, maybe cell phone and wireless internet, things like that. They're all pretty normal. And, I'll kind of throw this in here as a side note. I don't think negatively about ad backs unless ad backs get to be excessive. So, if you see the things like seller's cell phone and their wages and salary, yada, yada, that's fine. But when you start seeing ad backs for, their boat that they call a marketing expense or something like that, it's not necessarily incorrect because it is part of the seller's discretionary earnings. But at the same time, I really don't want to work with a seller or buy a business from a seller, from someone that is just egregiously spending money out of their business account and taking a tax deduction on it, which may or may not be legal. Oftentimes they're very stretching, they're really stretching the boundaries of what is legal there, so when they're adding things back. So that's just my kind of quick anecdote on SDE, but this is really what type of business this presentation is going to be applicable to. Okay, so on that note, now that we have some context, let's just kind of jump into it here. And I am seeing, I'm actually missing something in one of my slides. Okay, fixed it here. So let's go on and talk about the types of e-commerce business and give a kind of broad range of valuation multiples. So we understand what we're working with here. And really each factor will decide or push in a certain direction the valuation multiple to the higher end or lower end of the spectrum within each type of e-commerce business. There's 3 broad types of e-commerce businesses out there. First one, we'll talk about dropship businesses. Literally, somebody has a website, they sell a product on there, The order gets fulfilled by a third party and goes right from manufacturer or supplier to consumer. These types of businesses typically skew on the lower end at a 20 to 40x monthly multiple. Right now, these businesses in general really don't add much value to the transaction, which is why they're valued so lowly. Because anybody can often come in here, set up an account, start selling that product and getting it shipped out, then figure out an advertising channel, and boom, off to the races. They've got a business, and that can be done with really no barrier to entry and very little money. Now, those businesses that do well and have, kind of a growth minded owner will oftentimes transition to the next type of business, which is a direct to consumer e-commerce business. And these ones have a very, very wide range of valuation multiples. Because they can go from being, just slightly better than a dropship business, just, a hair above it. Maybe they start inventorying a generic product with a 3PL and shipping it out, right? So they had a very little value to a business that on the, higher valuation end of the spectrum has completely unique and proprietary products with patents that may even be manufactured in-house. Okay, so those businesses are going to be valued at the higher end of this range, which I typically see the range being 40x to 65x. Very few of them really get up into that 60x range, right? To be at that high end, you have to be a very, very high quality business. And there are some that go lower than that 40x, but oftentimes I see them, right now as of recording this in 2024, middle of 2024, oftentimes they're starting in that 40x range and, typically kind of going up to about 48x. And then, beyond that, you really have the outliers at 65x on that high side. But direct to consumer businesses can be very, very broad, and there can be a very wide scale of quality in these businesses. And then finally, retail resellers. Now, these businesses are selling somebody else's branded product. Okay, so think about maybe a online shoe store that sells Nike and Adidas shoes. I typically see these businesses going for 30 to 40x monthly multiple. Sometimes they can have value in terms of supplier relationships. Other times it might be anybody can get a supplier account. There's kind of some weird dynamics there. And ultimately, we see them in the 30 to 40x range. There are some exceptions and extreme outliers where they might be valued incredibly higher, and they're going to be retail resellers that have built a brand of their own. One of them that comes to mind is, well, Running Warehouse. I'm an avid runner, so I know all of these analogies, but they sell other, company shoes. They're a retail reseller, but that business, mind you, is going to be well outside of the revenue range that we're talking about here of sub $10 million. If they reach that point of scale where they get very high revenues, they can go for much, much, much higher multiples. And I guess, we should say that broadly applies to all of these types of businesses. So now that we've kind of got that out of the way and we know, what to look out for in the types of e-commerce businesses and where, we see the range of valuation multiples going in the current market, let's talk here about the actual driving factors. First one, profit margin and stability. Let's just say it directly. A business that generates a 50% profit margin is a lot more desirable and appealing to buyers, therefore having equity value, than a business that generates a 5% profit margin, right? As a buyer, buyers will pay more for that higher margin. But we need to kind of justify that with stability. So a business that just recently started churning out a 50% margin because they have, a one-hit product that's really cranking it in one ads platform, well, it's not going to look too stable. So that's really not going to drive the valuation multiple up. On the flip side, a business, that is doing, say, 25 to 45% margin, and it's been doing that for a few years, that's looking really, really appealing to any buyer. Therefore, the valuation multiple would be higher in that case. Next up on this, quality / brand / uniqueness of the products. Like, really, what are we selling, and is it a good product? It's not uncommon to run across e-commerce businesses that are kind of selling a generic product with really no value add to it. That happens a lot in dropship, and it also does happen a lot in kind of the lower end of direct to consumer product businesses. They find a product, the seller of the business has found a product, they found a marketing channel, and they found an audience that'll buy it, and boom, they're off to the races. But there's no differentiation among that product, and fundamentally, it would not be very hard for anybody to compete with it. Products like that in e-commerce businesses that are selling products like that are going to skew lower on the valuation multiple. There's really no other way of saying that. Products or businesses that come up with a unique product and can customize the product or even brand the product will do much better. So for example, I know someone that sold a brand of sleep masks. Now their product was not highly customized, but they had brought it in-house and were using a 3PL to fulfill the order, number one. And number two, they had built a brand that people really seeked out to buy that product. Okay. That business would go for a higher multiple because there's something, unique that the brand or that the business owns, and that is, in this case, the branded product. Right. Beyond that, differentiation, particularly if you can patent something and get a custom product, that really adds a lot of value. But the problem with that is, besides you have to actually come up with the designs and development of the product, is you may be limited in suppliers. So, and you may also have to purchase a lot of inventory to do that. So it's very difficult for e-commerce businesses to do that. And it's not often seen. Typically, what we see are direct-to-consumer businesses that have branded a product, maybe made a slight differentiation or variation to it that the manufacturer could accommodate, and are then selling it. And also quality of product. What are people really saying about the product? Is it earning good reviews? Is it not earning good reviews, right? There are some businesses that like to do reputation management and really just kind of get rid of people before they leave bad reviews. That's something you got to kind of flesh out as the buyer of a business once you get into it. How quality is it? So better products, ultimately, higher valuation multiple you will see. Going on with that is the ease and logistics of operations. Okay. How easy is this business to run? What does the team look like? What does the inventory situation look like? Businesses that use a 3PL will command a higher valuation multiple than a business that A, dropships, or B, keeps the inventory in-house. 3PLs add a lot of value because, well, then the buyer or the owner of the business does not have to worry about warehouse. They don't have to worry about staffing, all the headaches that come with staffing, all the headaches that come with warehousing. There's a lot of headaches that come with that when you actually take your assets offline and start holding them, possessing them in the real world. If you can get them to a 3PL, it is much easier. Now, you might be asking the question, why don't all e-commerce businesses just 3PL? Well, in some cases, the business may be adding value to the products, right? So they may want to, use custom packaging. They may want to bundle the products in a way that a 3PL cannot accommodate. A 3PL may charge too much if the item is like obscure, right? Say something like a giant beanbag chair or something. That item may take up too much warehouse space for the 3PLs. They don't want to accommodate that. It may just be cheaper to in-house it. But it's very rare that the actual warehousing of an item can be in-housed cheaper than it can be outsourced to a 3PL. And then fundamentally, the whole business is much easier to operate when there's a 3PL involved. So yeah, businesses that are easier to operate are going to command a higher valuation. The other thing too is, team infrastructure. Who's handling the support inquiries, right? Who's creating the content for the products? Who's running the ads? Who's managing the website? Businesses that have this all fleshed out will command a higher valuation multiple. Now, that said, it's much easier to kind of off-plate those types of things than it is to deal with inventory, which can be incredibly tricky to deal with. if you're taking that in-house. Or it's even tricky to say, hey, we've already got it in-house, let's outsource it to a 3PL. Ultimately, when it comes to the valuation multiple, I've said it, businesses that are easy to operate and easy logistically will command a higher valuation multiple. Next up, capital requirements for inventory. Ultimately, buyers do not want to have to spend a lot of money to keep inventory on hand. So businesses that have been built to really have a just-in-time production model are going to command a higher valuation. A business that's going to do, let's just say, $1 million a year in revenue and has to keep $500K in inventory on hand is very capital intensive. Now, there can be a huge kind of spread, in these requirements if a business is churning 75% margin, right? If you're doing 75% margin and have to keep that $500,000 in inventory on hand, it doesn't look so bad. But if you're doing a 15% margin on $1 million and now you have to keep $500K in inventory in hand, which is essentially 3 years worth of profit. Oh my God, that number, the math in my head there just sounds awful. No buyer is really going to want to pay very much for that business. So yeah, e-com businesses that can really figure out that just-in-time kind of fulfillment, i.e. drop ship, but not actually drop ship, are going to be worth a lot more in terms of valuation. And then finally, revenue sources here. What often happens in e-commerce businesses is, particularly smaller ones, is they can become dependent on one revenue source, and that is not good. This really subjects them to platform or channel risk. For example, a e-com business that is just selling the shit out of something with Facebook ads, right? And their revenue may be 5, 6, 7, 8 million. The revenue can be incredibly high. Their margin can be good, but it's all coming from Facebook ads. Well, as a buyer, you're assuming that risk of platform risk. What if the business gets banned from Facebook? That's unlikely to happen, admittedly, if they're doing that much revenue. But it's not completely uncommon either. It does happen. But more likely, what you're going to see is other entrepreneurs are going to notice on Facebook that this product is just selling like gangbusters because that ad just keeps getting ran and they keep getting hammered with that ad. The social proof is building up on there. And then somebody else is going to get into that market as well and start advertising on Facebook. And fundamentally, you're going to have the same offer, advertising to the same audience. And ultimately, the return on ad spend kind of gets arbitraged away. Right. So what looks good is having multiple sources of revenue. Now, the other, extreme example is an Amazon FBA business. I'm not a very big fan of Amazon FBA businesses because all of your revenue is beholden to Amazon. So they can eat you with fees because Amazon charges a commission fee for transacting on the platform. They charge you for warehousing and they require you to use their warehousing for it and charge you for the space of keeping it there. Wow. I really like Amazon's business model. And then they control how much exposure you get on the platform. So if Amazon wants to, go ahead and create their own line of product to compete with you, they just stick their products up higher in the Amazon search function, move you down. You've lost all your revenue and your whole business is beholden to Amazon. Ultimately, what works best is having multiple revenue channels, whether that's some organic traffic, some marketplace traffic, marketplaces being Amazon, Amazon, Walmart, maybe Wayfair, multiple advertising channels, those kinds of things. So you're not beholden to one platform. Now, on that note, now that we have an overview of all of these driving factors, let's look at some deals. And I pulled up 3 deals here, all of them from Quiet Light Brokerage. Now, I've never done a deal with Quiet Light, but in reviewing their listings, I find that they generally take kind of more quality, pre-vetted listings almost. There's higher quality of listings at a fair valuation, as opposed to some other business brokers that specialize in online businesses where you see them listing businesses that are fundamentally garbage. I don't know how else to say that. A lot of kind of one-trick pony businesses, i.e. content websites that are beholden to Google or dropship businesses that are just absolutely blowing it up with Facebook ads and were only started 8 months ago, right? those are not quality businesses. I look for established and profitable businesses. And yes, on that note, I will plug the AcumenWire right now. Actually, you can head to the AcumenWire and find a blog post of this where I cover more details that I think I didn't talk about. But AcumenWire is a newsletter I run where I send out established and profitable online businesses that were recently listed for sale. And I look for businesses that are likely SBA eligible and likely to stand the test of time going forward. So if you're interested in that, head on over to AcumenWire, input your email address, click the subscribe button, and you will get my listing deals as I find them and send them out. Typically, I send out one email with 3 deals a week. If it's a busy week, I might send out 2 or 3 emails with 3 deals a week. If it's a slow week, I might just skip it, wait till next week. It really depends on how many quality businesses are hitting the market. Anyways, back to the deals we're going to talk about today, which are e-commerce businesses here. This first one, a 20-year-old knife business, 22% repeat customer rate, $90 average order value, 2,100 plus reviews. Revenue $888,000, income $157,000, and they're asking $275,000 plus inventory for it, which works out to an annualized multiple of 1.74x. So this is very, very low. Let's see what is going on with it. It was established in 2004. It talks about a loyal customer base, 4.5 star rating out of 2,100 reviews, 22% repeat customers, and a low 2.5% return rate. This all sounds really, really good. What's wrong with it? Why are they asking only 1.74? Well, here it notes, although impacted by Google's helpful content update, the company has a strong foundation and is primed for a resurgence. And then if we also go through the listing, it will mention that the current seller of the business purchased the business recently and warehoused or brought the inventory in-house. So what we have here is a business that was recently purchased, likely when it was on the up, and it was driven by Google traffic. The seller purchased it, got whacked with the Google helpful content update, lost its traffic, and since then, the seller had brought inventory in-house. So now the seller is sitting on a bunch of inventory in a business that is no longer selling what it was. It's no longer driving the same revenue. And I bet that this $888,000 revenue also includes a substantial portion of revenue in the prior 12 months. It was pre-helpful content update. I think the helpful content update really started rolling out in early 2024. It's now middle of 2024, August that I'm recording this. So likely the revenue, if we were to look at what it's going to be for 12 months after the helpful content update, probably going to be a lot less than that 880,000. So now we see the problem, but at the same time, it's got the loyal customer base. The 22% repeat customer rate is very good. The 4.5 star average rating from 2,100 reviews is very good. And the 2.5% return rate on an e-commerce business is also very good as well, right? So there's a lot going on here. There's a lot going on here that really substantiates a little bit of equity value, but also, not a ton. Right? So if we kind of tie this back into the 5 factors, what do we see? Well, first, looking at the margin here, and I'll just do the math here, and that's 157 divided by 888. I think it'll be about 17%. It is 17%. 17.6%, right? The margin is okay. I guess not good. As I say that, I'm like, well, I really wouldn't want to deal with a 17% margin, right? So it doesn't really have a very good margin. The product, it seems like they're reselling other brands of knives. I can't really tell what's going on here. It may have said that. It said they have 1,100 SKUs, and I think somewhere in there it mentioned white labeling as an opportunity. So, they really don't have much unique brand or product going on. Ease of logistics and operations. Well, they've got them brought into a warehouse. That's really not too easy. Capital requirements for inventory are unknown. We don't know what the inventory amount is. And then finally, revenue sources, not good, because it's all dependent on Google. And I think that's really why we see it at a 1.74x multiple. If we annualize that, 1.74 times 12, 20.88. And that's on the lower side of what I anticipated a dropship business would go for. And actually, this is not a dropship business. This seems to be a retail reseller business, which I had those in the range of 30 to 40x. This one is very distressed with not many good factors pointing to it. Really, all of the things that they point out in the listing are good, but ultimately those are not what drives value. And if you buy this, you are really just buying a platform that has products that make 17% margin, and now you got to figure out how to unload them. And maybe the opportunity is you find an advertising channel, but at 17% margin, you're going to struggle with that. And B, the other option would be you bring the products in-house and create a private label. That may goose up your margin and allow you to advertise. But if you're doing that, why not? Why not just do that yourself? And then you have the inventory that the seller wants you to pay extra for. But if you're private labeling the products, that's going to be your whole premise. Well, you don't want to pay for the inventory anyways. I don't really see a lot of enterprise value here. This one does say currently under offer. Actually, all three of them went under offer, since they were listed. But that does not necessarily mean that this is what the asking price is. Maybe this is structured as some type of, or it does not mean that the asking price is what the actual transaction price is. Maybe there's, a major earnout involved here. And that's often what has to happen in these distressed listings. Okay, let's go on to the next one here. A 14-year-old eyewear business with exclusive vendor relationships and untapped B2B growth opportunities. It is doing $3.4 million a year in revenue, making $690,000 a year in SDE. I'm assuming it does not specify, it just calls it income. They leave it vague here at Quiet Light. I'm sure if you ask them, they would tell you. We're going to assume SDE based on its revenue. And that's at a 3.79 multiple, which if we annualize the 3.79 multiple, or excuse me, I said annualize, maybe monthlyalize, times 12, it is listed at 45.48. And if we go through the listing, we will see it was established in 2010, and it is an online leader in certified prescription safety eyeglasses, eyewear, and personal safety equipment. The business stands out due to a strategic partnership and efficient supply chain. They have secured exclusive vendor agreements with Luxottica, a privilege unavailable to new online retailers. These agreements allow them to offer top brands like Oakley, Nike, Ray-Ban, and many others. So we can tell that this is a retail reseller. They're reselling other brands. This competitive advantage, and that being their exclusive agreement, combined with their dropship model that minimizes inventory holding costs, has enabled the business to maintain strong profit margins and generate healthy cash flows. The owners have built a strong and capable team to handle the day-to-day. And after successfully growing the business, the owners are now looking to shift. Somewhere in here, I think they mentioned something about a contract. Oh, yeah. Additionally, the company is maintaining exclusive partnership with a government lab, enabling them to obtain the industry's lowest cost lenses. I really don't know much about what that means, but it sounds really good in this teaser of information. So we can clearly establish that this business is a retail reseller. Those typically trade in the 30 to 40x range. This one is a little bit on the high side of that. Now, why is that? Let's look at the factors here again. First of all, their margin at $693,000 a year on $3.4 million. What is that? Maybe 20%? 693 divided by 3400. Yeah, 20% margin, pretty much right on the dot, is decent. What really makes that a better margin, though, or a more appealing number, I should say, because the margin is literal, but a more appealing margin as opposed to our last business is the drop shipping some products to minimize inventory. So the business clearly holds inventory, but it seems like the bulk of what they do is drop shipping, which is very nice. Now, going back to the other factors, the quality / brand / uniqueness of products. Well, we can't really establish the brand value of the retailer, but they do have an agreement to sell these products that are very well established brands. And no online retailers can come into this space. That's good. And you often see that happen quite a bit in the retail business. We have over the last 10 years, such that retailers and their suppliers or wholesalers have stopped allowing new online retail accounts altogether. You have to have often a physical place to be able to sell online. And that is nice for the online business model, right? And that keeps out a lot of competition. The ease of logistics and operations, it sounds like they've got it pretty well streamlined with most of the products being drop shipped and a day-to-day team. Capital requirements for inventory likely very low if they're drop shipping a lot of their orders. And revenue sources, well, we don't actually know what that is at this point. I'd be curious to get into it and see how they're doing it, but I really don't know, and we cannot assume anything. That's something you'd have to do diligence out. Overall, though, I think the vendor agreements, the time in business, and the profit margin, particularly with minimal inventory required, drives this valuation multiple up to what it is, on a monthly basis at, if we did 3.79 times 12, it's going to put us at 45x. And that is actually outside the, kind of broad range that I described for this type of business model. So perhaps they have a lot of brand value built into it here, but if this is a good business, I would not be opposed to paying this. And I actually was interested in this, but they received an offer on it before I could actually sign the NDA and get the information. So that is that business. I liked this one. And then finally, the final one we're going to look at here is an SBA pre-qualified 7-year-old blue-collar workwear brand with 38% net margins and lots of growth opportunities. It's making $1,700,000 a year in profit on $4.4 million in revenue, which is a 2.7x annualized multiple. And if we put that on a monthly basis, 12 times 2.7, 32.4 multiple on a monthly basis. Now they want $4.6 million for this business. So that's quite a high asking price, I will say, at a fairly low multiple. Let's get some details. Sales come primarily from Shopify. TikTok Shop has proven to be a very strong new sales channel, accounting for 20% of sales. The net margins are an impressive 30%. The seller receives an impressive 3.8x return on ad spend on Facebook and Instagram and on TikTok. In today's difficult social media advertising, the business first soared on green high visibility safety shirts. Over time, the seller realized that hard hat stickers were a great expansion. They have a catalog of stickers. A small team handles all in-house production, ensuring competitive pricing in a 4,000 square foot space. And TikTok Shop generated $1 million in sales on only 2 products. All right, so reading between the lines here, they've got products that are easy to produce, and they're selling them through advertisements on social media. And they're warehousing them too and fulfilling the orders, probably producing the stickers and all that. It seems to me like this is kind of a trendy business model, right? Like they found products that are just trending, that they can reach the audience, and the audience is buying, particularly how they talk about so much kind of recent stuff, like things first soaring and, the last 180 days on TikTok's generating only, last 180 days has generated 1 million in sales from TikTok Shop on only 2 products. It seems like, they've kind of got a couple one-hit wonders that they've pulled together to generate this business. So in this case, looking at these 5 factors here, we got profit margin and stability. Well, yeah, the margin's high for now. I don't know how stable it is. It says this business was launched in 2016, but a lot of what they're talking about is fairly recent. We know TikTok was really not a thing in 2016. I don't even know if it existed, but it didn't really become a thing until 2020. So the margin may not be very stable here. The quality of the products and the brand and uniqueness overall, it's probably not much brand because they're just pumping ads. People are buying on a direct response basis. So there's no real brand value. The quality of stickers and shirts, unknown, but likely to be low, just from, kind of what I can tell reading between the lines here of how this teaser is written. Ease of logistics and operations. This thing's not very easy to operate with a 4,000 square foot warehouse that has some in-house production. Be much nicer if it was A, 3PL'd, or B, shipped out like print on demand style. Capital requirements for inventory, maybe not much, but you still got to pay the lease on that 4,000 square foot and pay your staff in there. And finally, the revenue sources. It's actually doing pretty well here. It's pretty well diversified. So I would say that this is a very low quality direct to consumer brand, which now, I've got the kind of range at a 40 to 65x here. However, there's a lot of negatives going for this business, and that is the recency of it, the kind of trendiness of the product, the lack of barrier to entry to it, and the relatively difficult kind of operations, right? Meaning that you have to have a warehouse, you have to have people in the warehouse sending these things out. Really doesn't lend itself to much. So I guess one thing that I'll kind of point out here is interesting, and maybe you caught on to this, is in the 3 examples, they actually fall outside the range of what I've kind of put in here as my assumed standard range for business models of these types. So, you really kind of have to look at every business individually and ultimately the market, right? Who else is willing to pay for a business? Who else is willing to pay what for a business is what determines the price. These ranges here are something that we can only kind of look at and say, yeah, that's kind of acceptable. No, it's not. But ultimately, the factors that are behind the business and really what make it up are what's driving the valuation multiple. On that note, guys, I hope you found this helpful and insightful on the driving factors of e-commerce business valuations. If you did, you know the drill. Smash the like button to help me out in the YouTube algorithm. I'd really appreciate that. And if you have any comments, or if there's anything you feel like I missed, and mind you, business valuation is a very complex thing here, and I could have missed a lot. I will say it's actually difficult to remember all of this stuff, when you are going through and recording it. I think I put more detail here into the actual written blog post on AcumenWire. So maybe I did miss some things. If you notice some things I did, let me know in the comments below. I'm calling it a wrap and signing off.